Welcome to the Commercial Real Estate Podcast powered by First National. I am Adam Pawadic, sitting here with Aaron Cameron at day one of the Toronto Real Estate Forum. It is the end of the day has come and gone. Everybody's into the drinks at the bar, so the background noise
a little bit noisier than normal.
Noisier than this morning when it was just coffee. But I guess that's why people come here for social time. This is also part of our speaker video series with the Real Estate Forums. And I want to thank our sponsors, Dow Vukovic, ML Emporio Properties, and Turner and Townsend. We have a returning guest, Amy Price, President, BGO. Her last appearance, though, was a virtual one, as was everything at the time. It was in the heart of first year of COVID. We would have recorded probably in...
I don't even want to remember. I don't even want to talk about it. Just...
So nice to meet her face-to-face. Vastly improved experience over virtual. And probably a more cheerful conversation today. There's a lot of negativity at the time. So, Amy, welcome back.
Thank you. Thank you, Adam. Thank you, Aaron, for having me back. And thank you for being here in person. I definitely agree. It's a better experience.
Yeah. I think we spoke last. You were located down in the U.S., California. Okay, so you came to visit us. Amy's previous appearance is available in the show notes if you want to check out the long form version of her background. We're going to do the short form version today, just kind of set the stage of her presidency of BGO. But give us the short form version of your background before we jump into it.
Yeah, sure. I really just happened into the real estate investment management business out of college. I lucked into it, met some good people along the way. So I spent the first basically 19 years of my career at Morgan Stanley on the real estate investing side of the business. And I've made one real career change in my life, which was leaving Morgan Stanley and joining what was Bentall Kennedy at the time. And that has now become BGO, and that's where we are today. So my background is really on the transactional execution side. My focus has been really on the U.S. markets and then North America more broadly. And I've been with BGO now for 11 years.
And how long as president?
Well, that is a good question.
We can pull up your LinkedIn real quick and check if you want.
Can you fact check me on this one? Because I don't want to be wrong. But a few years.
Say a few years. There you go.
Yeah, that could
Since
merger, 3 or 4.
Yeah, okay, yeah. There you go.
There we go.
Perfect.
Well, I guess probably worth mentioning, too, because we are at the forum. Amy is co-host of the forum. The only 2-day event, I think, on the calendar, so it doubles up her responsibilities over the 2 days.
Which is the only reason she said yes to this. She felt obligated.
I did, actually, yes. So.
She'll be here anyway, right? So
like,
you kind of have to.
Yeah.
Perfect.
Caught.
I'll take that. Yeah, I'll take it. So let's get into it. So 3 years ago since we've had you on, maybe just, if you can, kind of summarize what the BGO evolution has been over that time frame.
BGO has actually grown a lot and evolved a lot in that time frame. So when I was on 3 years ago, we were probably a year into being BGO. And obviously we'd had that COVID disruption early on. So I'd say we've really settled into being BGO. And what that means is that we really are a global business today. We are diversified across the US, Canada, Europe, and Asia. And we also have debt and equity strategies. We have core strategies, value add strategies. So we're far more diversified in the type of solutions that we're offering our investors and our clients. And I would say, kind of looking back at the last few years, thank goodness that we are, because we're in a market right now that is certainly more favorable toward certain strategies and opportunities and pretty challenging in others. So having that diversification on so many levels definitely helps us as a global business.
For those that don't know, maybe just describe, BGO's as Bentall Kennedy, but just a quick history, capital sources, kind of what you do, and the size and scope today.
So we manage over 80 billion of assets globally. About half of that assets under management in the U.S., 20% in Europe, 20% in Canada, and 10% in Asia. Our investors are primarily institutional. We might want to talk about, one of the focuses for us going forward, and we're very much in the early stages, is building some relationships and platforms to access retail capital. But really our business today is an institutional business. We have a lot of global pension plans and investors who we're honored to have as investors in multiple strategies across our business.
Privately owned?
We own 51% by Sun Life, so again, nice reason to come to Toronto. So we have the backing of Sun Life, which is very important, and part of that is capital to help us grow our business and launch new products. So that has been definitely a driver of our growth over the last few years. And then the other 49% essentially is owned by management.
Great.
I want to reference the previous episode before we get into more
Dangerous.
Well, no, this will come across as complimentary for sure. This would have been fall 2020. Everybody is terrified, and you were busy buying a hotel. And of course, hotels then occupancy was single digit, I'm sure, in some of them, and it would have seemed like we'll call it a bold strategy at the time. But now looking back, it looks very, very smart because of course hotels have just been on a hockey stick ever since. So can you tell us about that particular bold strategy?
Yeah. Well, and actually on that one, I happily will. I do remember that we bought a hotel in Nashville, and at the time, probably what I'd said or what was interesting at the time was not just the point in the cycle in which we were buying it, but it was actually the first asset that we bought post-COVID that we did like virtual diligence on. And we had like a security guard with an iPad kind of walking around showing us the mechanical system or something like that. So it was definitely a risky bet and a conviction play, but we really felt like we would, in 3 to 5 years, have that path to recovery. And honestly, we got there sooner than we would have predicted. So it did, it was Nashville, it reopened, occupancy did come back, people wanted to travel. We were able to catch that tailwind, and we actually sold the asset probably about a year later.
Wow.
And we made a lot of money.
Yeah.
That's the happy end.
Yeah, exactly.
That's not a life coach strategy you typically see deployed.
No, and in hindsight, I wish we could have done 10 of those, but it was pretty one-off, and we don't do a lot of hotels, and it was also just a unique set of circumstances at the time. So.
Yeah, of course.
Especially the southern U.S. opened up a lot quicker than Canada,
Exactly.
we'll call it. So you would have seen that occupancy rise very quickly. Here, you'd still be waiting, but
Exactly.
And then the other thing we talked about in our previous conversation was rapid compression of industrial cap rates during that time frame. Of course, money went to near zero, or debt went to near zero, which helps quite a bit, and industrial valuations shot up. Or we're now decompressing those same cap rates.
Yes, we are.
So what's your view on how dramatic the decompression is versus our previous talk about how rapid the compression was?
Yeah, well, and that's definitely, that's a different story. So I guess what I'd say is, I think probably when we were having this conversation a few years ago, I think what I would have said and what we would have been talking about is just, are we at a point of over compressing our cap rates and over expecting growth? Does it just, there was just a tremendous amount of capital that wanted to own industrial. And I actually think that one of the biggest drivers of cap rates aren't necessarily interest rates, it's really liquidity, right? The more liquidity there is in the market, the more people have to pay up. It's pretty simple. And I think since then, what I'd say is we've probably, in the last 3 years, we have probably given back, half of that outsized appreciation, which is probably healthy. It really wasn't based on fundamentals as much as it was based on capital flows, again, and liquidity. I think, in the last 6 months or say a couple quarters, we've really seen the transaction activity come through in the U.S. at least to a point where you have some market data and you are seeing cap rates, for both what people are buying at today and an expected kind of mark-to-market cap rate, which is probably more meaningful, right? And an expected growth rate really all, come down. So what I'd say we're seeing is that those fundamental metrics like a discount rate or a cap rate expectation are probably down 20%. Maybe up 20, but
whatever market,
they've
against us.
They've gotten worse by 20%. There's been some income growth to offset some of that, so maybe values in total have come down 15, but that's off of a peak that was probably 30% more than it necessarily should have been. So I do think there's still room for some downward pressure, and I think we'll see that as we really start to bring liquidity back into the market in a meaningful way, which really hasn't happened.
You mentioned the U.S. Are you seeing that same trend in Canada?
I think we will see a similar trend on a more muted basis and on a delayed basis.
Why do you think that is?
Primarily because Canada doesn't have as much volatility around capital flows and liquidity than the U.S. market. That being said, I do think it's interesting to consider how Canada is going to fare in this kind of, as we see how this cycle really plays out, both in terms of what the bottom feels like and then how it comes out of that. If you look back at the global financial crisis, Canada really never missed a beat.
No, there was a pause. That was
really was a pause. Exactly, that's a good way to say it. And really, if you look back, why? I mean, it's because of the ownership, and it's because of the banking system and the liquidity.
You're welcome.
Yes, thank you. Yeah, well, congratulations. But I don't. I do think, again, relative to the U.S. and other markets, Canada is relatively well positioned, but I do think there will be more cracks in the system this time around. And that is culturally, that's a culturally tough thing for Canadians. I hear comments in Canada frequently that, why do borrowers provide recourse? Well, because recourse never gets called, right? And no one would ever default on a loan in Canada because then you won't do business in Canada again. And these kind of long-held beliefs. And again, generally speaking, I understand where that comes from. There's a lot of truth in it, but you look at what's happening today already, and there are examples of those situations occurring, right?
How many major players in the marketplace have gone into receivership in the U.S. in the last 18 months? I don't know. I'm not expecting you to know the actual answer, but is it 6, 100?
Are you hearing about it? Yeah.
Because in Canada, I think it's 3. Like, it literally is 3, right, so far.
Deals?
No,
or the developers.
Like developers.
Known
entities. I'm not talking the smaller guys, but the major headline guys, there's 3. Right, and I don't even need to name them, but they're like that's over 12 months. There's been 3. I think that's shocking to a lot of Canadians, and I think I'm trying to interpret what you're saying is that I think there's more to come, probably.
I think a little bit more, but just the point that's shocking is that you're making my point. I agree, right? It is been very uncomfortable. In the U.S., we're a little more used to it, right? And it is a more volatile market, and that's part of our experience, and it's part of our, it's part of what our future will be. I don't know the answer to your question, honestly, as to how many kind of receiverships there's been, but
it doesn't even make headline news. Probably it's not.
Yeah,
exactly. The Globe and Mail's putting it on the front page, right?
Right. I mean, we barely hits the news when a bank goes into receivership, let alone a real estate developer. It's just part of the daily news.
We call that Tuesday. Yeah.
Well, the Americans kind of stand up, brush yourself off, and get going again.
Exactly.
Well, I mean, maybe just to hammer this home, recently, or maybe not that recently, but Brookfield walked away from an asset down in the U.S.
Yeah.
And up here, people were going, "Oh my God, Brookfield's failing," and obviously that was not the case. It's just in the U.S. it's a totally different environment.
It really is. And again, part of it is capital structure, right? When you have a kind of an investment manager with a fiduciary obligation to the equity, you got to make the best decision in the present to preserve that equity capital, right? And it's not to say that that's not true in Canada. I just think you have a different ability with different sources of capital to think longer term and to, kind of invest into an asset that you believe is going to have long-term value. But that duration question is very different in the U.S. And if you're really thinking about, what's right for the asset for the next short period of time versus longer period of time, it can lead you to 2 very different rational conclusions. And in the U.S., you see more of those decisions getting made because of where we are, more near term.
And no recourse.
And no recourse, exactly.
So is recourse in Canada part of the cracks you see in the system, that you're going to pull in a web of properties if somebody collapses rather than individual assets? Or what's the rationale behind the cracks in the system?
Well, I think the cracks in the system are that, one, that there are defaults on assets that are happening. And again, obviously office being the place where you're seeing it first. I would guess that most of what we will see will be in office. It's certainly more distressed. And I think the other challenge with office is that it's hard to look forward and know the future, right? And so if you're on either side of that table, you're the borrower, you're the lender, everyone's trying to figure out, who's going to put in the next dollar, how do we move it forward? So it's very challenging. So I think the cracks in the system are more that borrowers having to say, I can't make the investment going forward, kind of taking a different view, and whether that's because of recourse or not, or with or without recourse. But I do think we're going to see recourse stepping in. I mean, banks are going to have to rely on that, and they haven't done that before. So.
Yeah, I mean, we as lenders have talked about that. Recourse gets taken all the time and so rarely comes into play.
Right.
It's
You mentioned liquidity as one of the drivers for valuation that we saw kind of at the end of the last cycle. And I imagine you're sitting on a whole bunch of quote unquote dry powder, tons of liquidity like many of your peers are. This is not a liquidity crisis. Some people have, survived to 25 has been a thing that's been going around. I'm already getting sick of it, but we will remind everyone that there was a survive to 95 at the same time, right? And the difference, there was no liquidity back then. That was the problem. It was liquidity crisis. That is not the same now. As you sit where you are, with your scope, how does that impact what's going to transpire as we survive through to 2025?
Yeah. I mean, I will redirect a little bit. I mean, there's not a liquidity crisis. I agree with you on that. But the more nuanced perspective I'd share is that there is a liquidity crisis for certain types of assets and strategies, right? There's absolutely a liquidity crisis for office. There's no liquidity for office right now, right? I'd argue there's kind of a liquidity crisis for core real estate. No one wants to invest into core right now. They're waiting for values to kind of hit the bottom, so to speak, and that will change. So there's a little bit of a disconnect between where the dry powder sits and where opportunities are in the market and where you have conviction. And it works when you can kind of put that Venn diagram together and find the middle. And right now they're kind of dislocated. So I do think there's money on the sidelines. I think once, we hit a couple of these key, like again, when values are really kind of in the core real estate universe seeming to hit the bottom, and when you see some momentum and some signs, I do think capital will return pretty quickly. But the other side of it is that, at a high level, there's a lot of conversations that I think are getting reconsidered within pension plans as to their allocation and their targets between real estate and other asset classes. And I'm not sure that real estate wins in that. I don't think it loses materially, but I'm not sure it really wins. And what does that mean? It might mean that, for some institutions, they decide to kind of hold steady or even cut back their allocations to real estate by a couple points for the next few years, or particularly when interest rates stay high and credit's a really attractive alternative. So I do think that while we don't have a liquidity crisis, I don't think we're going to necessarily expect to see the same robust capital flows into real estate as an asset class that we did in the last cycle. Because again, part of what we were benefiting from was we were the yield generator, right? We were offering growth and income in a world where it was really hard to get income from debt, right, and other strategies. So real estate played very well in that environment and benefited materially from that low interest rate environment. We don't get quite the same favored nation status in a higher interest rate environment.
Would that return if interest rates come off and we get to the next cycle?
Yeah,
It's
sure.
be a temporary.
Yeah, I think it's temporary. And again, I don't think it's dire, but I think on the margin, it's going to be kind of a headwind as opposed to a tailwind for us.
Like, you don't need too many large institutions to put purchasing development on pause to have a major effect on the real estate market, because you're talking about billions and billions and billions of dollars that is just no longer active, right? And the market feels that, and you only need a slight liquidity crunch to put a bit of a dark cloud over us as real estate practitioners. So the idea of stay alive till 2025, I know we keep getting back to this. For you personally, what does that mean? Like, for you to get through to 2025 with the least, scars, what does that mean for you?
I think it means two things. Number one, it just means, I guess it means a few things. So number one, I'd say, it's just head down, blocking and tackling, doing everything we can to drive occupancy in the assets that we own today, right, and position those assets for the present, right, and the go forward, right. You have to be competitive, and it is a knife fight, and I think that's true. We're seeing pressure in multifamily. We're seeing it across the board, and as you said, it's interesting because if you look forward a bit, maybe that's part of staying alive till 25. The development pipeline, the supply, that equation is going to shift, but right now there is supply. It is being completed. It was started in the last cycle, and there's some of that still working through the system. So I think one is just being really aggressive to keep your properties leased and to think about how to make sure they're positioned to be first in line, not last in line when there's demand in the market. Number two is absolutely capital structure. What can you do to alleviate liquidity issues or just, have time with lenders. So there's a lot of focus on capital structure, definitely part of staying alive. And I think also keeping morale up. I take an internal lens to that question as well. I think it's hard to be a very transactional business, whether that's developing, buying, leasing, selling, raising money. I mean, it's just, we are a transactional business and company, and people are wired to consider success equal to or related to, the velocity of transaction. So, how you keep people motivated, how you kind of take that time to build strategy and think in other ways it's less transactional but really important to the business and motivates people. I'd say that's also a big part of just staying alive.
Yeah, saying no can be very profitable, but it doesn't feel like a win. Like,
Exactly.
we're here to do deals.
Right.
And that's tough on the morale. Yeah.
It's tough on morale. I mean, it's one thing to do that. And if you think about this, I mean, it's really been 3 years already. And I think we went through the COVID and people felt like we were coming out of it. And then you kind of get hit with the supply chain, interest rates, inflation, Ukraine. I mean, now we've got Hamas. I mean, it's kind of one thing after another, and all that weighs on people, right? It weighs on us all, I'm sure, as humans, and it weighs on our industry, it weighs on our business. So, I just think you got to put in perspective, and we are asking a lot of people right now, and have to recognize that a lot of people have, a lot of different kind of stress points and experiences in their life, right? So
be patient. We'll get through this.
Be patient. Stay together.
You've got great perspective, with the global investment. In this inflationary environment is global. It's happening all over the world. I think, but everybody's at different cycles. Maybe just talk about what your experiences are, the different cycles, and why, and what you're anticipating. You're bringing it back to the Canadian context.
So different geographies?
Yeah.
Yeah, well, I'd say what's interesting, well, I don't know if it's interesting, but, well, it is, but maybe obvious too.
Interesting to you, yeah.
But, is that Asia is probably the most disconnected from what is impacting Europe and North America, meaning China's a huge question mark, obviously, in
Do you have any Chinese
Asia.
exposure?
Very little, no. But we have a significant business in Asia, but it is 80% Japan.
Okay.
And then South Korea, a little bit in Hong Kong, and a little bit in Australia. But we're very Japan focused. So what I would say is that, obviously the whole Japan economy works a little differently, and I'm not the best one to get into that. But what I would say is that also from a property perspective, in Tokyo and major cities in Asia, they didn't actually have the same return to office headwinds and challenges, right? They really never left the office. So office is performing very well. It's a very different set of circumstances. And just again, from an investor perspective and from a capital flows perspective, I'd say the investor sentiment hasn't materially shifted either toward or away from, Asia as a whole. It's been pretty consistent. So if you liked it before, you like it now. If you didn't like it, you didn't like it, but it's kind of on its own. The connections between what's going on in North America, and I put both US and Canada into that, and then Europe, I'd say, are definitely more tightly aligned, where we have many more of the same experiences for obvious reasons. Europe's a little closer to the distress of what's going on not only now in Russia, Ukraine, but obviously Israel, and won't even go into that.
Yeah. The geopolitical stresses are just closer to home.
Thank you for saying that more eloquently.
Yeah.
Yes, the geopolitical. It is really next door, so that is having a greater impact on Europe. And I think our view is that there will be, a greater probably impact on recession and stresses to the economy, but then also opportunities that come with that. Quickly on U.S. versus Canada, what I'd say is usually what I'd say is Canada really follows the U.S. in many ways. So I think if you look to the U.S., you can really get some good insights as to kind of where Canada is headed. That's just kind of the way that markets tend to work. Right now, there's a lot more volatility, as we were talking about before, in the U.S. market. I actually think Canada's very well positioned, again, relative. And there was a panel on it earlier today at this conference where someone was advocating really for Canada being arguably the best positioned country of the G7 at least, and why. But immigration is part of that. Technology and innovation is part of that. The banking system is part of that. But there's really a lot of resilience to the Canadian economy, particularly compared to the U.S., that I think is going to be a real differentiator for the markets over this cycle.
So typically what Canada offers to global investment is not like everything you said, but typically yield, like outsized returns, is not part of that. How do you think Canada will stack up on what is usually a weaker category for us, which is just outsized returns, as compared to the U.S. over the next little bit?
Yeah, no, it's a good question, and I do think that is a challenge. And there's also, when you talk about the foreign flows of capital, you have to layer in like FX and taxes, and there's a lot of structuring that goes into international investing. And not to get into details I'm not versed on, but I think there's been some shifts lately in some of that regulation that has shifted the attractiveness of foreign capital that used to kind of benefit Canada over the U.S. from a leakage perspective of like what does it cost to invest into the market. And it's actually looking like the U.S. becomes a little bit advantageous to Canada. So part of how Canada also would attract foreign capital is because on a net basis, when you think about returning that capital on a global basis, there wasn't as much leakage, right? So I do think that's something that you got to factor in when you're thinking about the global capital flows. You asked me about yield. I think that Canada is generally a market that is better at providing lower risk adjusted returns than the outsized returns. But that doesn't mean it's a bad place to invest, because I actually think relative to the risk, it's quite attractive. But it doesn't have, again, because it doesn't have the same volatility, it just doesn't have the same outsized opportunities, I would argue, right? But where Canada tends to do a very good job developing the yield in that outsized return is actually with construction and development. It's a market that people build in, right? And it doesn't create your yield out of the block, but it does.
And if you haven't heard, we actually need more housing in Canada.
Well, and you're not alone, right? But yes, you do. And especially with immigration, right? It's your positive, and it does so much to drive demand for real estate and obviously the economy more broadly. It's such a positive and a necessary part, but obviously it's also very much a challenge to house those people.
Yeah, and unfortunately we don't have any time to get into that today, but
yes.
And we'll save tax structuring for the next one too.
I was going to ask.
Third appearance.
Yeah, please explain. One last question, I think, just to end, Amy. What are you most excited for going into 2024 and beyond?
Well, I guess, to me, the excitement and the opportunity is I think it's going to be a great vintage, if you will, to be an investor. I'm excited to get to kind of be back really being strategic and thoughtful about how you deploy capital. I do think it's going to be a market where you have to be really selective at an asset level. And, we kind of went through a period where the rising tide kind of lifted all boats and that tide receded. So you have to be really thoughtful. But I think to me, the opportunity and what I'm excited about is that allows managers candidly to be able to differentiate themselves a bit more. People are going to do things a little differently. And again, not just kind of by market or by property type, but actually by asset. So how do you try to think about being a winner in that game, right? And again, we don't have time for it, but we're actually using AI and technology a lot more to help us just be another voice in the room of market selection with a go-forward lens. So I think really the excitement to me is we've taken a pause, we've had time to really think about our convictions and our strategies. The fun part is getting back to the execution. And how do we do that in a world that allows you to be a bit more differentiated, and how do we do it well? So
great. Well, stay tuned to the next episode with Amy Price on AI use in real estate.
Yeah, that came right at the end.
That's the hanger for the next one, okay? Yeah. I'd like to thank First National for powering the podcast. Thank to our sponsors of the speaker video series, Dow Vukovic Al Emporio, and Turner Townsend. A reminder to our listeners to subscribe, rate, and review if you like what you're listening to. And again, thanks to Amy for coming on. Really appreciate you taking the time out of a busy
you,
day.
A&A.
You started first thing this morning.
3
Yes, 3 A's. That's right. Amy, Aaron, and Adam signing off.
One more day to go.
Bye.